Welcome to Barchart's weekly series of webinars designed to help you, the trader and investor, better understand a variety of trading concepts, along with the pages and tools that Barchart provides to support you in making a more informed investment decision. Today's subject, the foreign exchange markets, or more commonly referred to as Forex. Now, a well-rounded, educated investor needs to understand how this multi-trillion-dollar daily market affects all markets. And even if they don't have an interest in trading Forex, Forex many times is the invisible hand behind our market trends. Hi, my name is John Rowland. I was going to start by looking at some of the basic concepts around Forex and then build towards a more complex trading ideas and strategies that are not particularly unique, but are more common with FX. So for my more advanced or experienced Forex traders in the room today, let me build a base for our junior, less experienced traders before we jump into the deep end. With me today always is my partner and our moderator, Jean Baker. Hello, Jean.
Hello, John. How are you?
Good. So last week you jumped into the captain's chair. How did that go?
And I think it went okay. Yeah, but John, it's really nice to have you back this week.
Well, I'll tell you what, it's nice to have wanted back for sure. So listen, every time you talk about bar chart, I learn something new. And one of the things that I learned about dashboard was that, come on, dashboard, wake up. It never works when you want it to, right? Was that when you go to your watch lists or your portfolios, you have it over here on the side there, but if you pull this over like this, that you can see, your data boxes that you've created either in the views or in your custom views.
Oh,
and so
yeah.
That's something that I didn't know that you could do. And I really like that because you can watch a series of different markets, and then if you see something based on one of your indicators or pivots or whatever, you can jump back and forth real quickly and have that nice big screen right in front of you. I really like that.
Well, I'm glad you learned about changing the views on dashboard. That helps.
So I always enjoy when you talk about bar chart. All right. So just again, as a reminder that today's session is for educational purposes and should not be construed as an endorsement to purchase or speculate on any particular security, and that individuals that all trading have a form of risk to them, and that it's important for you to seek the advice of a qualified financial professional, and that you understand your ability to bear risk in your decision-making or trading decision-making processes. Okay. All right. So what is some of the basics of Forex? Well, Forex is the largest financial market in the world, and it accounts for almost, actually, I did the research just before this webinar. It's actually up to about $6.6 trillion a day in daily transactions. And that is more than all of the equities and future markets combined. So it's important for us to understand that how powerful this market is because it's so large. It's made up of several different types of banks, commercial banks, central banks, investment banks, and what was sometimes referred to as over-the-counter or retail brokers. Now, one of the main critical differences between the financial markets that you might be more familiar with, like the stock market or futures markets, which are singular exchanges, FX is not centralized. It's a network made up of these brokers and banks, right? And this is critical for us because because it's not centralized, there's no regulatory body behind Forex, especially in terms of safety measures like circuit breakers and limits. So many times we can see, well, not many times, but outlier events where we could have, a major movement in Forex, and there's no security as terms of risk for us. To protect us, as we do see like circuit breakers or limits in some of our more regulated exchanges. Also, as a retail trader, you need to understand that when you enter the market, that your broker platform that you're using is actually taking the other side of your trade. And although it could be very insignificant in terms of price, there could be a possibility that there's a better price out there in the Forex world offered somewhere else, not particularly on your broker. Now, it's not going to be significant, but it does add up after a while. So this non-central markets can be a slight risk or a major risk for us, depending on the events that could happen. All right. So how is Forex put together, or what is it called? So we have what we call currency pairs, or sometimes referred to as cross exchange rates. So FX is quoted in these currency pairs. We'll be looking at two different currencies. The first currency is referred to as our base currency, and then the second is our quote currency. So when we look at the price that is going to be quoted for us, it's the base currency, what one base currency would be worth as it is to the quote currency. So for instance, the US dollar CAD currency quote would be 1.2752, which means that $1 US would purchase 1.27520 Canadian dollars, right? And this is important for us to understand because we'll be looking at changing the base currencies and the quote currencies back and forth. Now, almost all national currencies can be traded, but a majority of all of our Forex will revolve around these 7 major currencies: the dollar, the euro, the yen, the pound, the Canadian dollar, the Australian dollar, and the Swiss franc. So in our bar chart under the currency section, we do have something which is called the popular cross rates, which is what we're just going to look at. And you can see that Barchart makes it very easy for you right off the bat here. There's our 7 major currencies. And then you have like this little spreadsheet that shows you these cross values. For instance, here, we got the US dollar to the Canadian dollar. There's our 1.2684. But if we go the other way, right, Canadian dollar to US dollar, notice that the quote changes because one Canadian dollar only purchases 1.78883. So you can look at it this way. All right. Now, what else Barchart does for us is it shows us these cross rates. We have 36 of these major cross rates, right? It's just basically the general of the ones that mix up of all those different currencies. Notice that a large amount of our 36 pairs is the US dollar. And there you do see some of the more, what I would call exotic currencies: the Brazilian real, the Chinese yuan, the Korean won, and so on, Russian ruble, some of the other ones, okay? All right. So some other currencies we can think about include the New Zealand dollar. That's one that's been coming a little bit more popular. Mexican peso, the Swedish krona. We'll look at why Swedish krona is one that we could have in our arsenal of currencies. Chinese yuan, definitely one that is been more active in recent, and Norwegian krona as well. Okay, so what are some factors that can influence our Forex? Well, the differentials in interest rates, and this is the key to Forex. When we look at the value of the two different currencies, this is really one of the main drivers: is what is the interest rate in one country's currency versus the interest rate. Now, sometimes this is referred to as the carry trade. Now, we're not going to go down that rabbit hole today, but it's just that difference between those domestic interest rates, right? One currency might have a higher interest rate, and so that currency will have a greater value. Macro events, right? As goods and as money flows in and out of an economy based on paying for goods or services, or as capital chases investment opportunities. And so money can flow in and out of an economy based on economic expansion or recession, right? Central bank policies will have an effect on FX rates, quantitative easing, rate changes, and currency intervention is definitely something that we need to be aware of when we see our central banks trying to manipulate or intervene on behalf of their currencies. So let me do that for you. I want to show you an example of that one. So what I've done here is that one that I want to show you is the Swiss franc versus the euro dollar. Now you can just come to the cross right here and click on this, and it will take you right to that currency. Now I've already opened a tab for us, and I want to show you. I'm going to go back about 10 years on my chart. And let me kind of widen this out a little bit. Actually, you know what? Let's go to 5 years. And let me widen this out a little bit for you. Okay. Oh, hang on. Patience. There we go. Okay. All right. So about 7 years ago, whoops. There we go. About 7 years ago, the Swiss central bank wanted to defend the Swiss franc versus the euro, and it didn't allow the euro to fall below 1.20 or 120, and it held that market. Now you can see that from about end of March of 2012 through that whole summer, the Swiss central bank held the value of the Swiss franc to the euro, and then price moved away. But then when price came back, or when the market came back to that value, that 120 value, what happened was that the Swiss decided that they didn't want to defend it anymore, and they pulled their support for the Swiss franc. Now, this happened in a very short period of time. Now, notice our candles here are weekly candles, and we have a big price movement in a very short period of time. 1 week, that's candle. But I'm telling you, this price movement happened literally in minutes, almost in hours after the Swiss franc, after the Swiss pulled their support. And many of the retail traders and retail brokers went out of business. One of them that I would think of that comes to mind is FXCM, which was a retail Forex trader. And this created a huge risk in the market. Matter of fact, this price movement, I think one of my Forex buddies told me, was, in terms of just one contract, was like a $25,000 move. So it was a bloodbath. So this is that risk, non-central markets, and of currency intervention. But I think also what's just kind of cool about this one is when price came back. Now, if you guys come to a lot of my sessions, we talk about how price remembers, and I really think it's kind of interesting that when price came back to that 120 mark, that was kind of like the ceiling of this currency rate, and since then we can see that price has moved away. All right, so that's an example of currency intervention. Fiscal policy, economic stimulus, taxes, or any kind of restrictions to capital flow, right? Capital likes to be able to be free, likes to be able to run around and chase, returns. And if a government puts in some kind of restrictions, you'll see a flight of capital from that currency. So that will have an effect on our Forex as well. All right. The US dollar, right? Well, that is one of the currencies that we're going to look at. And there's a reason why we're going to look at the US dollar, because it's the most heavily traded currency in the world. And it makes up, over 80% of all international transactions. And it's sometimes referred to as the greenback, right? But what's important for here to understand is that the US dollar is regarded as the world's reserve currency, right? So that many nations, many central banks use the US dollar as their reserve currency. Now, what has happened over the last few years, and the last decade or so, this dominance of the US dollar has fallen, and it's, first the euro kind of came on, challenged the dollar, and then in past years, we've noticed that the Chinese yuan, has been gaining acceptance in other parts of the world. For instance, the Saudis now write oil contracts in yuans. Now, this is my own personal opinion, and traders' view is that we reap a lot of benefits as U.S. citizens, as the U.S. dollar is the world's reserve currency, and that foreign nationals are willing to buy our debt. That's one of the reasons why of reserve currency. And I don't know what events could create. I know a lot of folks are worried about a bubbles and this and that, and debt bubbles or equity bubbles. I believe that the bubble will pop, and I don't want it to, but I believe, my personal belief is that when the U.S. dollar falls from the world currency reserve, that will create this domino effect that could upset a lot of our markets. Okay. Although the dollar is used as a major pair, right? It's one of the major pairs that we're going to look at. It can also be compared or in something called the dollar index, and we're going to look at that as well in our talk today. And the dollar index can be traded as a futures contract as well. So this is the breakdown of the dollar index, sometimes referred to as the Dixie, and it has 6 different currencies in it. The euro, the yen, the British pound, the CAD, the Canadian dollar, the Swedish krona, and the Swiss franc. Now, the first thing you want to notice from my chart here is that it's not to scale. But more importantly, what I want you to understand is that the euro makes up almost 60% of the dollar index. So this is important for us as in a comparison and convenience, in terms that it's basically the inverse. When we think about the currency pair, dollar to euro, we can look at the dollar index, and that will give us kind of an idea of this inverse of the US dollar to the euro, but also the US dollar to this basket of world currencies. Okay. All right, so that's just some basic concepts under Forex. Okay, so let's go back to our main page here, our Forex market overview page. And this, again, this is like all of our overview pages on Barchart. This is going to give us a quick snapshot of currencies, news stories, heat maps, trading ideas, and stuff and so forth. Now, notice that under the major U.S. dollar rates, the first one that is on top is the dollar index. Again, it's not a currency pair. It's not an exchange rate. It's this basket of currencies versus the U.S. dollar. But then below that, we do have the euro versus the US dollar, the dollar versus the Canadian dollar, and so on. Now, I did see a question pop up about cryptos, and that is the gorilla in the room. That certainly is popular right now. So no, we're not going to do cryptos today. We will save that for a session sometime in the future. So I apologize. I'm sorry that we're not going to talk about cryptos. But over here on the right, we do see our heat map. This is going to show us which currency pairs are active, right? In terms of greens or dark colors, those would be positives. Reds would be negatives. Our Forex trading signals, we can look at combinations of strong buys or strong sell signals, right? I could look at those as well to get some trading ideas. And we'll come back to that in a little bit later. Another cool feature that is on this page is some news stories that could be Forex related. Notice that today we do have this headline which says risk on rodeo continues. And we're going to talk about this concept of risk on when it relates to currencies. Longer term trends, bullish and bearish trends. Again, a way for you to look for some quick ideas. Just a little bit farther down here, we have metal rates. Now, the chart up here on top, gold, platinum, palladium, that's going to give you the value of these commodities in terms of US dollars. But you could go in here under the all rates button, and then you could see actually the value of gold, silver, platinum, palladium as it relates to those individual currencies, the euro or the yuan or the Canadian dollar. And that's kind of a cool way to also to get a different perspective of some of these markets. Sometimes, gold might be expensive in dollar terms, but it might be cheap in the euro terms. And then below there, we have 1 month performance leaders. Again, a way to look at maybe a little bit of a shorter term trends, some trading ideas. Now, notice that our 1 month leaders, the ones that advancing, we have the British pound. So here you can see some ideas that, hey, the British pound is one of those currencies that is strengthening not only against the US dollar, but against a lot of other currencies. And then under the declines, notice that we do see the US dollar here is declining against some of these more lesser currencies. I'm not saying lesser in terms of the economy. It's just that not actively trading. So you can get some trading ideas from that as well. All right. Okay. So let's go back to the top of the page. And let's go to long-term trends. All right, so this page here, what it does for us is it gives us a nice picture, in other words, a chart view of markets that are in longer term trends. Now, notice that it does say that this longer term trend is what has happened over the past year, all right? And you can see a variety, not only those that are performing well to the long side or up strengthening, but also those that are weakening. And again, we talk about that US dollar as the reserve currency, and again, this is just my observation, is look at how many of the currency pairs that are in these long-term downtrends are US dollar pair relationships. And that, for me as a trader, is kind of concerning. But let's move away from that for more. So one of the ones that I do want to look at right off the top of the bat is our Euro FX versus the US dollar, because a lot of headlines that we've been hearing is US dollar market manipulations in terms of fiscal stimulus, but also today the ECB, the European lawmakers, got together and said that they're going to create a stimulus program as well for European. And also the ECB just a couple of weeks ago came out and said that they feel that quantitative easing is going to be part of their arsenal over the next 6 months to a year because they don't think the economy is coming better. So we have this battle between these central banks, the U.S. Fed and U.S. Fiscal policy versus central bank policy of the European nations. So I have a chart here of the Euro FX US dollar, and I kind of was looking at this morning, and not particular for Forex, but in this case, just chart patterns. I know that there's a lot of folks that are interested in certain types of chart patterns. And this one is a classic picture of what we call a head and shoulders. And a head and shoulders is really just how, as a market moves, transitions from one trend to another. And so you can see that our long-term trend was that the euro was appreciating against the US dollar, and we were in an uptrend. And an uptrend is defined by higher highs and higher lows. And then on head and shoulders is really this transition from an uptrend to a downtrend. Here you can see that a downtrend is defined by lower highs and lower lows. So that we do see that happening. Now, what has happened in the last few days is the price of the euro dollar relationship has fallen below this neckline, could be the beginning of a new major downtrend. But in the big picture, right, our longer term trend, what we just said was that it looks like it came right where it needed to hold support in this time. So where is the dollar going to go versus the euro? I don't know. I think that if we are in a new downtrend, certainly I don't think the dollar can rise much higher, certainly not above that 122 level. But maybe if we fell back below, let's say 119, that would be confirmation that we are now in this new downtrend. Okay. All right. So the next thing I want to talk to you guys about is a concept of this risk on, risk off. So let's go back to our main page, and we talked about that news story, this risk on, risk off. And one of the things what we'll discover in Forex is that there are certain currencies that have a tendency to perform better when there's an appetite for risk in the world, in markets. And certainly in the last few weeks or so, that appetite has been there. We see a lot of money coming into the equities markets. So those currencies that are risk on type of currencies are the Australian dollar, New Zealand dollar, and the euro. Now, the euro has fallen versus the US dollar, but it had shown some strength against some of the other currencies. But let's go to the Australian dollar versus the US dollar. Excuse me, not the US dollar, the Japanese yen. Let's do that. And let's think about this. We're talking about risk on, risk off. I'm talking about equity markets, but what does the Australian dollar or the Japanese yen have to do with, let's say, the S&P or our stock market? Nothing, right? Really, not really. But what I've shown you here is we can see the Australian dollar, a risk on currency. This blue line here is the S&P and the S&P 500. So what we're seeing here is as the market takes on risk, goes into the equity markets, certain currencies will shadow those equity markets. Now, what's cool about this is, here's a long-term picture that's over the last year. I mean, it literally shadows the S&P market. And yet we're looking at a currency pair that is in the Pacific Rim. So somebody who wants to invest in, let's say, the stock market, or doesn't have the capital, let's say, to trade S&P futures or to put money, to buy some of these more loftier stocks, here's a way you can trade the stock market through currency pairs, which is kind of a cool thing, all right? So if we have risk on, what's the opposite of risk on? Well, we have risk off. And risk off is when investors feel that they think that there's going to be a fall in equity prices, or that they fear that there's some kind of event that is going to create uncertainty or bring risk about to them. So we have some currencies that are risk-off currencies, or sometimes referred to as safe haven currencies. And those three are the dollar, the Japanese yen, and the Swiss franc. So what we're seeing here is risk on Australian dollar, risk off Japanese yen. But let's go and look at two risk off currencies, US dollar, yen. As that loads up. All right, and let me go back about a year or so. And let me tighten this up a little bit. What I want you to notice here is, again, this is the US dollar to the Japanese yen. And our blue line does represent our S&P market. And you can see the S&P market is going up, everybody's happy. S&P starts to fall, risk off, right? Now folks are fearful. And we can see that the US dollar was peaked out, it was at about $1 to 112 yens. And during that time, the S&P fell, this risk off time, the yen dollar, right? The dollar fell to where it can only purchase 101 yen. So the yen appreciated, the dollar fell. This is this risk off scenario. You can see back in 2019, in the beginning of the year 2019, we see the same event happen. As equities fall, so does this relationship of the US dollar to the Japanese yen. So I have a trader friend, his name is Ed Ponzi. He's written a few books about Forex. I know that's kind of funny to hear, somebody's name is Ponzi in terms of trading, but yeah, that's his real name. And I'm stealing a concept from him. He talks about the Japanese yen in terms of the currency of misery. And I love this term. And what it really says is that when the world gets fearful, or when there's some kind of event, that creates misery, right? COVID, for instance, money flows into the Japanese yen because they believe that it's a safe haven. So thank Ed for that discussion in terms of a risk off and the yen as the currency of misery. Now, I want to show you something here that is kind of interesting. Is for the first time in a long time, we're seeing a divergence, right? This yen as the currency of misery, yet we see we are in a risk-on appetite, and yet the dollar is decreasing. Again, when I talked about this reserve currency, this is one of the things that I've noticed in the US dollar, that maybe there are some other factors that are behind the scenes of the US dollar that we as Americans aren't aware of, and that maybe some, multinationals or currencies around the world are gaining strength because of loss of faith in the US dollar. So that's something I'm going to keep an eye on over the next few weeks or so. Okay? All right. So let's go back to our currency page. And as I'm doing that, I want to pause here and look at a couple of the questions that are popping up. Let's see. Andrew asked, the Norwegian krona has been the most stable contract currency over the last 7 years. I didn't know that, Andrew. That's pretty cool to know. Let's see. There's a question here from Ray. Hey, Ray, how's it going? Ray is one of my followers. Where there are any other periods, such as divergence of the U.S. Japanese yen SPY happen. I haven't really researched it, Ray, but we could look. We could look it around. So Robert asks, is the Aussie dollar considered a risk on? Yeah, it is. Yeah, the Aussie is a risk on currency. the US dollar is a risk off. And if we went to that, you would see, hey, I see Samuel Evans is in my class, and he says, I don't know enough to ask a question about, but I'm enjoying this webinar. Yeah, Sam, I'm sure you don't know anything about Sam is a friend of mine, so a very smart trader. Okay, so the next thing I want to talk about is under our main page here is our new recommendations. And here you're going to look for opportunities for different trades that could present themselves. So you can see that under our new recommendations, we have 9 contracts that are giving us 100% buy signal. Now, when we talk about how we define buy and sell signals in Barchart, we have 13 different technical analysis, which shows you right there. And this one is showing that all of them are in that positive or bullish scenario, 100% opinion, short-term, long-term, medium-term. And you can see that we are in this risk-on environment, and the Australian dollar is one of the ones that is performing a little bit well. I do notice that the British pound, again, is one of the ones that has been performing well. If I go back to my Forex recommendations, I can look at 8 contracts that are sell signals, and I bet you we're going to see the dollar is majority of those as well. Okay, so these are ones that are longer term, short term, intermediate term, so you can jump on and ride that train. Now, sometimes what they'll do is one of these different indicators that we have, short-term, medium, and long-term, they might signal a buy or sell signal. And one of the ones that I'm particularly fond of is the 20-day moving average. I use it for equities. I use it for Forex. So this does give us a new buy signal today. I think I looked at this morning, and I think it's an exotic one. Yeah, US dollar versus the Hong Kong dollar. All right, but a few days ago, we got a buy signal on the 20-day moving average in the, let me just remember which one it was. I believe it was the Aussie dollar, US dollar. So I think somebody asked about that. Okay, so let's look at that one. So Aussie dollar, US dollar. Okay. And let's go to our chart. And we'll talk about what these red lines are going on here in a second. But we do see that this Aussie dollar, US dollar risk on, we are in a nice uptrend over the last year or so, last 6 months or so. And in recent days, we did get a pop up. Now, I do have a chart that I've already pre-made that I have as my 20-day, 100-day moving average. I use this more for equities than I do for Forex, but we can go on there and you can see that here we see price of the Aussie dollar did pop up above the 20-day moving average, which is technically a buy signal, or is interpreted as an opportunity to go long. And so this is one of those indicators that I do like using when I do some analysis, and was as far as Forex is concerned. Okay, so let's talk about some more advanced concepts outside of what I've just talked about. You know, understanding fiscal and banks, central bank manipulation. So one of the things that we can talk about in terms of all markets, but certainly for Forex markets, is there's a concept that I believe in. It's called the 3-hour trader, which says that that in the morning sessions of our markets, and I've talked about this in Forex, in futures and in equities markets as well, but in that first 3 hours of our day, right, let's say about 8 o'clock in the morning to 11 o'clock in the morning, let's say here on the East Coast, this is when new orders start to flow in, when markets are becoming active, when liquidity starts to grow. And you will discover that during that time between 8 and 11, in these centers of economic activity around the world, that price action will start to pick up. Now, we're talking about the Aussie dollar, US dollar. So we're talking about two different parts of the world. But I'm going to go to a 1 month chart here. And let me just widen this out a little bit for you. Right? Let me tighten it up. There we go. Okay. So I just randomly drew some lines around where we see price change direction or where I see price accelerate in terms of my trend. Now, remember, think about Forex, right? Forex is a 24-hour market, it's around the clock, right? Do you think that a businessman or an organization or a central bank, let's say in Australia, is going to wait to when the US market opens to do their business? No, they're going to do it in their time, right? And when they're active in those morning sessions, they're 8 a.m.s, right? Now, Australia is halfway around the world. It's about 12 hours ahead of us. And look at these lines, right? And look at the times here. How many times that we see around 8 p.m., we see an acceleration of price of our trend or a change in our trend, right? That's when these countries, when activity, when liquidity, when orders are coming out. Now, also think about economic reports that come out, the unemployment reports or gross national product reports, right? They don't come out in these countries during our morning sessions. They come out during their morning session. Those are drivers to Forex as well. Notice that the other time that you see here is 8 a.m., which would be the U.S. market, right? The U.S. time. So again, if I'm looking at U.S. currency pairs, U.S. dollar currency pairs, you will see that this 8 a.m. time frame. Now, I want you to be aware of is that what is your main time frame on your default time frame on your bar chart setting. Now, notice mine here is Essential Time. So if I'm in the East Coast, it'd be 8 to 11. If I'm in Chicago or Midwest, it could be 7 to 10. If I'm on the West Coast, it's going to be a little bit earlier. But let's think about now Europe, right? Let's go back to that Euro Swiss, right? And we think about Europe. Europe, they're 8 to 11. And if I'm in here in the U.S., that's around 2 to 5 a.m. in the morning. But if I'm in the Midwest, Chicago time, it's about 1 a.m. To 4 a.m. And if you are a Forex trader, you probably have realized that a lot of your price action occurs in the overnight hours in these early morning sessions. So another thing for some of us who have regular jobs or, as far as lifestyle, maybe equities and futures markets, we don't have that time, but maybe you're a night owl or you are an early riser. These markets are very active in these early sessions. And again, look at some of these lines where we see changes in price in terms of tops and bottoms. 8 a.m. U.S. markets when the U.S. and European markets, but see, look how many of these price actions occur at 2 a.m. So you can use this 3-hour trader to help you find better entries and exits, or to help you discern when you'll see reinforcements to your trends or changes in your trends, okay? Now, let's look at another example, and this will transition to another discussion. Here's the Canadian dollar, US dollar to North American contracts. let's flip it around. Let's go US dollar, Canadian dollar. Let's do it that way. There we go. Okay. So what we would anticipate? Now we're going to anticipate that we're going to see price actions that are going to occur during that 8 to 11 time frame. If I go to my hourly chart, my 1 month hourly chart, right, and give me a second here to expand this out a little bit, right? Look at this, 9 o'clock, 8 o'clock, right? 8 o'clock, 9 o'clock, 8 o'clock, right? 9 o'clock, 8 o'clock. So again, our trends are going to be more influenced, or when we see our central banks are going to be more active, or our larger banks are going to be more active in these morning sessions. So take advantage of this one. This one is a really good tool, especially for Forex, okay? So that brings me to another discussion about Forex, and that is that there are some currencies that are defined as what we call commodity currencies. And these are currencies whose economies are derived around, commodities or real goods. And one of the ones is the Canadian dollar, and the other one is the Australian dollar. So what will happen is you will see this correlation between the US dollar and the Canadian dollar, or the US dollar and the Australian dollar, and commodity prices. So for my Forex traders, my futures traders, this is a real powerful tool for you to see if your trend is intact in terms of these different currencies. Now, notice here we're looking at, again, the dollar versus the Canadian dollar, and we see a falling dollar versus the Canadian dollar. Here dollar can purchase 1.5 Canadian dollars, and down here it's only purchasing 1.26. Now this blue line here is not the S&P, which I showed you before, but it's something called the Goldman Sachs Commodity Index. This symbol here, GDY00, is the cash value, and I just want to show you on Barchart here where it is. There's the symbol GDY00, and this is the S&P Goldman Sachs Commodity Index. This is an index of a basket of all commodities, and you can really see this here, right? As the dollar is falling in value, it's less purchasing power. We see commodity prices going up. But let's think about Canada. Canada, right? It has, some commodities more so than others, maybe not a whole basket of commodities. So let's go into the compare. And I'm going to take off the Goldman Sachs, and lumber is definitely one of the commodities that Canada exports. Look at that, right? As the dollar has weakened, so has the rally in price in lumber prices. Now, another commodity that is unique to Canada is wheat. They grow a lot of wheat in Alberta and places like that. And so this is the wheat cash price. We do trade wheat in futures contracts. But again, you see this correlation of falling US dollar, strengthening Canadian dollar, and these commodities that are unique or unique to the Canadian dollar, okay? I could go into the Australian dollar. Copper is a commodity that they're not a major producer of copper. I think they're probably like 4th in the world, but you'll see a relationship to that. HGH, I'll just do the futures contract. And there you go. You can see that correlation to it. Another thing that Australia exports is natural gas. They have a large liquefied natural gas, and so there's a commodity index for the Western, for Pacific Rim. It's the Japan Korean marker. It's a index that's based on natural gas. And again, you can see that that correlation is there. Okay. All right. So commodity currencies. All right. Okay. So let me pause, ask, read a couple questions. Any questions that are popping up, Gene, that you're hearing, that coming across here?
A few people have asked about setting alerts on Forex symbols, specifically with like the 100% buy and sell signals. And yes, that is available for you to do. Basic price alerts are available with a free membership. If you're a premier member, and that's what John is showing you right now, you can set, for instance, if you want to see when this symbol, if you go to the opinion indicators, or even Barchart opinion, if it falls into the 100% buy or sell category, you can set an alert for the symbol there. So those are a few questions that came in.
Okay, cool. Again, I always learn something. Cortland asks, is it true that London and New York sessions tend to be main drivers of price movement for more often than any other clock times? So Cortland, yeah, for sure, especially if you're going to be looking at a currency pair that has the US dollar or a European currency. But the Japanese yen. I mean, if you guys ever watch TV in the evenings, there, Bloomberg TV comes on at 7 o'clock at night, and they have the Asian market morning. So this morning concept of 8 to 11, you can apply it to not only to Forex, but Forex around the world. But think about commodities that trade around the world: gold, crude oil. That come to mind. You will see that, as Cortland says, that you will see drivers of crude oil prices, drivers of commodities like gold during those European sessions. So yeah, great question and great analogy. Okay. So there's a question here: is what are the top best pairs to look for? So I think it's important for you to mix it up. I don't want to pick any one pair over another pair. Certainly, I think the major ones that we can talk about is in our popular cross pairs is these ones here: the US dollar, Australian dollar, and any combination of those, looking for those opportunities. So one of the things that you can do is you can go to like today's surprises, which is kind of cool. This is like a little heat map here. Oh, hang on. Excuse me. I want to go to the Forex map. This little heat map here, and what you can look for is these trends as one currency. For instance, like for today, the Japanese yen is falling against all these currencies, right? Well, the stock market, this risk on, risk off environment. So that's a way for you to look for trading opportunities. What I kind of do is I will look for those longer term trends, for instance, that Euro US dollar trend, and then I will look for that contra movement in a shorter period of time to see it gives me an opportunity to get back into that trend a little bit cheaper, right? So if I see my US dollar the euro is increasing, I want to see a day when the dollar is greater, has a little bit of a price movement versus the euro. That could give me an opportunity to get into my longer term trend, right? Short term momentum, longer term trends. I like longer term trends, certainly when it comes to currencies. So MS asks, what is a good pair to measure the volatility in equities market? So yeah, MS, I think you can look at these risk on, risk off. The Australian dollar, New Zealand dollar for risk on for equities, but like I said to you before, the Japanese yen, that currency of misery, is a great currency to look for. When you start seeing the Japanese yen rising in value versus all currencies, especially the US dollar, that could be a sign of something imminent on the horizon. Okay? All right. So I'm getting towards the end, but I do want to show you one more thing here. And I'm going to go to the dollar index. And we talked about the dollar index as the inverse to the euro. And remember, we saw a head and shoulders. And here we see that inverted head and shoulders. And I don't know where the dollar is going to go, but certainly if this uptrend is intact, then I would be concerned if the dollar fell below 90 in the next few days, right? If I look at this in a longer term picture, let's even go out to like 10 years, right? You can see that this 90 to 88 area is a very critical area for the US dollar. If it doesn't hold over, let's say, the next few weeks, next month or so, there's really nothing here for the dollar to hang its hat on until it falls all the way down to 80 cents or 80. So that is something that I'm watching currently. I think that there is some opportunity, maybe to test one of these lows and then bounce back off of it, back up. But you can see that we really need to get back above this 90, 91 area to really show us that the dollar is strengthening against our currencies. I don't know which way it's going to go. I'm going to let the tape tell me the story. And right now, the tape is telling me that the dollar looks like it's going to go a little bit lower. Now, one of the things that, one last thing I want to talk to you guys about that is very unique in terms of candlesticks, and you will see this in a lot of our currencies. And now I'm going to encourage you to watch this session over again. And I've hidden these in a lot of the charts that I've looked at. Is this candlestick formation, sometimes referred to as an engulfing pattern or a cover cloud, where you see two candles of relatively same size where the red candle engulfs the green candle. Now, you could have it the other way around on the downside. But the key here is that the closing price of the up candle has the same opening price of the down candle. Now, what this signals for us is not necessarily all the time, but what institution or what market participant could be large enough to stop a rally like this in its tracks, and not only stop it, but then push price the other way? In currencies, central banks. And so when you see this price pattern in terms of Forex, this could be an indication to you that you are looking at central bank activity because of this effect that they're such a large player. Their footprint could create one of these types of candles. Now, this is a 6-month candle, and this is a daily. And you see it here, and we see it here as well. So that could be part of that process. Now, I can go to multiple time frames, and I can see these candles in all time frames, not just dailies. I like to find them in these higher time frames. But let's go back and look at some of the ones that we kind of went through today. Here's our US Canadian dollar that we just looked at. And let me go to a smaller time frame. Let's see, and boom, there's a nice one right there too. So they're all over. They're in all time frames, right? They can be found in multiple time frames. Now, the one that I liked about this one here is, which is kind of what I like to find, is notice here I'm in a 60-minute time frame, and there it is, right? But if I went back to my daily, excuse me. Yeah, I think it's my daily here. I think it's also there as well. Let's see. Yeah, you can kind of see it right there. Okay, so look for that price pattern. Let's see if we can look at some other ones that I've, right? There we go. There's our head and shoulders, right? A change in trend, a very quick change in trend, change in our trend, right? There's sometimes I refer to these like twins or pinchers. They're great little Japanese candle structure that you can look for, that you can find in all time frames. But again, I like to find them in these higher time frames. But let's see. Actually, you know what I wanted to show you? Let's go back to that risk on, risk off one, that US dollar, the Japanese yen. And you can go back again, watch the video as we go when you get a chance to look at it. Again, I'm in a daily, right, daily time frame, and let's go back, right? Nice little, there it is, beautiful, right? Nice. But let's go back to when the stock market crashed. Look at that one, right there. So that's something that's unique to Forex. You'll see a lot of these twin type formations, these covered clouds, or what we call engulfing candles. And yes, they are, you can find them on the downside as you can find them in the upside. Rely on those ones. You can get some nice trades out of those. Okay, so we are at the top of the hour. I see that I've answered a lot of your questions. I don't see any of the ones. Let me pause here for a moment to read a couple more of the questions.
And if I can just pipe in and say that if John did not get to your specific question, you can always email support@barchart.com, and our wonderful support team will be happy to assist you and get back to you with an answer.
Okay, cool. All right, I think I answered most of the questions that are up there. I know what Gene's going to make me show you guys is that next week,
yes.
Next week, we're going to look at our strength and direction signal indicator in Barchart. And what's nice about this one is it is a little bit confusing to some traders how to use it. What I talk about a lot of times in my sessions is this dilemma that traders have is about momentum versus trend. And what is really nice about the strength and direction is it allows us to look at trend and it allows us to look at momentum and help us to find some greater opportunities. So I'm looking forward to that one. I think you guys will enjoy that one. So make sure that you sign up for that. Anything else you want to add, Gene?
No, that's pretty much it. With strength and direction, if you are one of those people who are really interested in the Barchart opinions, and if you look at opinions and you see strength and direction, this kind of ties into that as well. So John's going to cover a lot of things next week. Good. It'll be a good session for you to attend.
Exactly. I think you'll really enjoy it. So let me just show where you can find that. Here's our Barchart opinion. We're under a strong sell. If I look under my more information, oop, is that they don't have it for? Where's my little?
Nope,
there it is. There it is.
There it is.
There's my strength and my direction. Strength is for longer term. Direction is our momentum, and you can see that both of these right now are showing us that the momentum and the trend are in favor of the Canadian dollar or a weak US dollar. Okay, so listen, I hope you guys enjoyed today's session. Thank you for being here. I want to wish everybody the best of health, stay safe, and the good of all trading.
Thank you again, everybody, and thank you for using Barchart.com. See you next week. Bye.